Okay, so I'm going to start. We have a very distinguished panel, and in the way of these things, we're going to start with everyone giving 10, 12 minutes of prepared remarks, and then we're going to have a discussion. And you can all see that I am not Maya McGinnis, who unfortunately had a family emergency, so she wasn't able to be here to moderate this panel, so I'm going to do my best to step in, and I think it will be, you know, we felt it was important to, this panel is really the essence of dealing with issues that are the essence of what this conference is about, because when you think about government assets and liabilities, the way they are represented to the public is on government balance sheets. And so what is represented, what's left off, what should be on that isn't on, how to use the information on those balance sheets is kind of front and center of what we want to talk about. So with no further ado, our first speaker is Bob Merton, who's going to talk about contingent liabilities and balance sheets.
Thank you very much. Everyone who's had experience with me knows that I have to set a time now or we'll run over. So I want to make sure I don't run over you, Davey. So let's see where we push this, push the stopwatch, and start. Okay, there we go. Well, good morning. I'm glad to be here. As we see what the topics are, I have a couple of observations. Now, I only have, she told me 15, but I'll need all of it. So let's get right started. I think the issues were laid out a bit yesterday, and Debbie just did a good job today. The issue in focus here is on balance sheets particularly as a tool to be used with respect to government issues, decisions, and analysis. What I want to introduce here immediately is the tool I have in mind that I think it's been very useful for a variety of applications, and I'm applying it here, and I call it the risk balance sheet. I don't claim fame to the name of that. I'm just telling you that's how I've always described it. And it's not GASB, it's not GAAP, it's not something you have to pass around to compare to other institutions. It's a managerial accounting sheet for making analysis and decisions. So let me just take you through a hypothetical example here. What we do is if we're doing the US government or any government, we lay out, just as we do with any balance sheet, all the assets of that government, not its cash flow, not its, not its budget, not its income statement, but the balance sheet, because we're going to be talking about risk. And the only way you can look at risk is to look at the whole. You can't look at one year's dividends in a stock and use that to infer what the risk is. So on the left side, I'm not going to spend too much time, but it's important to distinguish it. A lot of things are on this balance sheet that don't appear on the official balance sheets because that's not the application. And what we have here is all the assets of the country, all right? And we can talk about if you have questions or something about how you go estimating all of this. That's not the point. So you have taxes, et cetera, et cetera. What I want to point out is, this is a hypothetical, but you could have 2 or 3 sovereign wealth fund type things, some specialized to pensions, others, generic for the country, all right? And then you have state-owned enterprises and so forth. So that's the assets. Now, on the other side of the balance sheet, I hate to call them liabilities in this context. I call them pre-commitment. They're commitments. The government, like everyone, has made commitments that it has to fulfill. It's promised to make it. It's issued debt. It has to promise to pay it back. It has various numbers of obligations. So this part of the balance sheet is like liabilities. I've tried to line it up roughly in some notion of seniority where I think decisions would go, but let's not get into it. But you can see everything's here. We got foreign debt, foreign currency, local currency, et cetera. And very importantly, we have down here contingent claims, which is something that Debbie talked a lot about, and which I'm going to use as the example of how to apply this and how to analyze it. Okay, now one thing I'd mention here, just as an application of this, first, I'm applying this just like portfolio theory, right? You have assets, you have your liabilities, and then you have what you're trying to manage, which is the uncommitted, or if you like, the equity, or whatever you want to name it. which is the uncommitted part of what the government's assets are available. And with this, let's just look at the sovereign wealth fund. Now, if you look at sovereign wealth funds as if they're an island unto themselves, which is often done in terms of, let's say, how they should invest, okay, just for good investments, that's the wrong way to look at it, because the sovereign wealth fund is not an island unto itself. It's a piece in a very big, complex puzzle. And the first rule of portfolio theory, 0, what matters is the risk and characteristics of the whole, not the component parts. That's been established for 70 years. So in order to think about just a decision of what the sovereign wealth fund should do, you really need to place it in the context of the ultimate beneficiary of that, or at least the government in this case, all right, with all the other things that the government has, both other assets but also other liabilities. Otherwise, you really don't have much control over anything. So next point is just simply, if you take GIC of Singapore, one of the largest, we don't know how large, but one of the largest sovereign wealth funds in the world, and you take the Petroleum Fund of Norway, a very large one, okay? If you look sovereign one to sovereign wealth fund, you might say, they ought to do the same thing, or something like that. But that's missing out the point, because what matters is the risk of the component. You have assets minus commitments. It's the residual that you're trying to manage. That's all you can do. And it's the residuals risk that matters to you. I shouldn't call it residual. It's the reason. So as far as I know, Singapore has many, many wonderful assets, but it doesn't have any commercially viable hydrocarbons or oil, gas, or anything else. Norway has a little bit of that. So if you get down the balance sheet here, you find government state-owned enterprises. Well, you're going to find a very big number there for Norway in the petroleum area. So what you're worried about is how all of this moves, not how each piece moves. Therefore, if you were Norway, you wouldn't want to be investing, having nothing to do with anything else but good investing, optimal investing. You wouldn't want to be holding any of the petroleum in your sovereign wealth fund, whereas Singapore, which has no commercial ones, might put a lot. So as soon as you start to use it, the larger element of embedding individual, large but important but not standalone elements, you end up with very different decisions. And if you're trying to evaluate, for example, I guess stick with sovereign wealth, keep moving, that you can't just compare them because you're comparing not the right things. You have to look at the whole. If oil does very well, even if there's none of it in the sovereign wealth fund of Norway, they're going to do very well with another one of their assets. That's the key point there. Here, I just want to point out something that's not generally well taken, or in some cases not at all, is when you look at all the different liabilities, the contingent claims, the guarantees was where I'm going to go right now. And so the first point I wanted to make is that you put everything in here, and you can't know what's risky for your assets unless you know what you're committed to. So if you have lots of pension liabilities, from the asset side, it may be that an inflation-protected long-term bond, whose price has lots of volatility in it, may be exactly offsetting. It's the risk of the difference between this and this that drives your whole process. So the risk balance sheet does two things. First, it takes account of everything, not for centralized planning, but for analysis of where you are, who you are, and et cetera. Now, you need something that trues that up, but let me move on. But I want to underscore, this can be used for almost anything, but it's very useful for this purpose, okay? Now, what I want to talk about is, no, I just need two pieces of paper. All right, I'm going to talk about contingent liabilities, in particular, if you want to think of it as guarantees by the government. It could be deposit insurance, it can be any kinds of guarantees the government puts on. As you see, it's down here, well, it was down there on the list. So if you haven't, I know many of you in the room have already seen this, but just in case there is somebody who hasn't, I'm going to make you a credit risk expert in 3 minutes, okay? I'm assuming you know what options are, so you need to know that, but here we are. I have in my hand here a mortgage, a bank loan, a bond, some kind of paper like that, okay? And it has credit risk, meaning some possibility it may not pay. It's not a junk bond, it's just some chances it may not pay. Now, it's a dollar bond. I attach to it a full faith and credit U.S. guarantee of that bond. Functionally, what do I have? I have a risk-free asset, right? Certainly as risk-free as any, say treasury, right? Now, I'll take the guarantee off. What am I left with? A risk-free bond minus a guarantee. That's just 2 pieces of paper, right? That's not a theory, that's just application, all right? So, we've learned something already. The guarantee is the difference between the value of the bond if it were risk-free and its value as it is, the guarantee being the difference. I'm not going to run it through because I don't have the time, but if you look at this chart here, you say, well, what is the guarantee's characteristic? Well, anywhere you have any kind of contract, leave away all the frictions. Basically, there's 2 choices. When you come to have to pay, you either pay and everybody goes their way, they get what they were promised and that's it, or you can't pay or don't pay, in which case you're going to get, if you're the holder of that bond, you're going to get something less, all right? So what's the value of the guarantee? If you get paid, nothing. It's like you buy an insurance policy on your house, it doesn't burn down. At the end of the contract, it's worthless. You didn't need to do it. You didn't know you didn't, okay? But what happens if they don't pay? Then the value of that guarantee is it pays you what you were promised, and the guarantor of this gets whatever the assets are worth. So putting it this way very simply, the value of a guarantee is a maximum of 0, that's when it doesn't default, and the promise payment minus what the assets that are recovered are worth. If you look at that formula, you immediately notice that that's a put option by any other name. Maximum 0, some fixed number, the strike price, if you like, B, $1 billion or 10, minus whatever the assets are worth on recovery. So the first thing we've learned is, independent of any model, it's not Black-Scholes or any of those, it's any model, structurally, a guarantee is a put option. And we know a lot about put options, and we have lots of experiences with them, and we know how to value them. So that helps us to understand guarantees in a way that is very useful. But I want to underscore, it's not model-based. You can use whatever model you want if you want to do the valuation. Okay, now I want to show you 2 of the problems in credit risk in general, all right, that need to be pointed out. Because it's a put option, okay, the guarantee, and remember, the real bond is a risk-free bond, we all know what that is, minus the guarantee, minus the put option. The put's on what? The assets committed by the borrower. So if the borrower has certain kinds of assets, those are the assets that are the collateral. Okay, so here we go. Now, what I want to show you here in this picture is, first, this is what the price of the bond would be depending on the value of the collateral assets, okay? All the collateral that's behind it, including any promises, anything else, but it's the value of the collateral. And the curve of that looks like this. I'm just saying it asymptotes that the risk-free value if there's an infinite amount of assets, okay? Now, suppose you're here. You have this many assets. These are all, by the way, mark-to-market. None of this wholesale blah, blah stuff, book, anything. These are mark-to-market. You want to know the actual value today as best you can assess it, all right? Now, suppose you're here. You see this is the value of the bond. What do you see here? A small move in these assets will have an impact on the value of the bond. If the assets go up, the bond will go up by some amount. If the assets go down, it will go down by some amount. You can see that in the curve. Because it's nonlinear, what you see here is always, for a small movement, it's going to move that way. So to put it in more perspective, you all know what a risk-free bond is. I'm just going to look at the guarantee part, because that's the part that's really risky to the bank or whomever it bought the bond or the loan. And put options, the curve looks like this. So you're here, and the value of the guarantee is here, but how much does the value of the guarantee change? How much risk is there in the guarantee? The risk is being driven by the underlying assets, but how much? Well, you look for a small move, you see you get the slope of that line, of that curve, to that tangent, to that curve. So let's say you say, what if there's a dollar move in the assets? Well, maybe that curve is 0.01, 1 cent. So that says my risk is if these assets move by a point, I'm going to either gain or lose a cent. So that's my risk, right? Does everybody see that direct connection? That's key. Now, what I want to point out to you, though, is it's a dynamic world. So you start here. What if the assets fall? Well, the price of the guarantee goes up, the price of the bond goes down, because it's minus a guarantee. The bond holder is guaranteeing it, all right, or the government. But what else do you see that's not so obvious? It's not just that the price goes down, but what happens when you roll the dice again on the value of the assets? Instead of moving by 1 cent for a $1 move, it can move by 5 cents for a $1 move. What I want you to see, this idea of just looking at historical default rates, that's history. That depends on where you were at the time when you took the observation. This is where you are now. You were here, now you're here. That's the important point. It's where you actually are, not where things were historically. It's nonlinear. You can't just use historical fits, regressions, and so forth to answer it. And it's very, very insidious, because you don't think, you say, well, it's the same bond I had yesterday. More or less, it has the same risk. Answer, not necessarily. Because as you can see, if the assets go down, the risk goes up. So you know the value of your assets, but what you may have to not take into account is how much the risk has changed for you. Particularly in crisis situations where you have, like in 2008, 3 such big downturns. So you can see, you can start out here where there's almost no sensitivity because you have lots and lots of assets, and a couple of bumps down, your risk can go up 5, 10 times. Okay, so that's the first picture I want you to show from your credit risk understanding, that risk changes, and it changes materially. Okay, so that's the first message. Now, that's for the bank. Let's just call the bank for concreteness. That's on their loan. What about the government? The government has guaranteed the banks. So it's run a guarantee of a guarantee. Well, you can see if you remember, convexity is when you hold water in a curve, okay? Well, you can see this is very convex. What do you think happens when you write a contract where you are guaranteeing a guarantee? You're writing a guarantee, which is convex, on an asset or a liability, whatever you want to call it, on something that itself is very convex. So what happens? It's really convex, meaning the government's piece is the tail, that if there's small moves, that slope is going to be much steeper. The change in risk, there's a word for it, it's called gamma in the Greeks or something. But you see what I'm trying to say to you? Think of a convex thing. If convexity creates this kind of pattern, which we saw here, if you then guarantee the convexity, you're doing convexity of convexity, you really get a very, very fast-changing risk level. That's what can get governments into trouble. They think they're fine. They have some shocks to the system, and another shock. They say, okay, well, that probably moves things down a few, 50 basis points, 100 basis points on the yield curve or something on the curve, on the pricing. That's not what's happening with risk. So that's the first, if you like, lesson. Keep that in mind, because that's useful to understand crises, why it is that the first time you get a shock, it moves a certain amount. The second time you get the same shock, it moves much more. And that's nothing psychological, it's just mathematical because of the convexity. So this is not any You don't have to do anything complex with behavior, okay? Now, the next thing I want to show you is real-world characteristics. I took the COVID period. I took eight companies that you all recognize, Apple, Walmart, et cetera. You'll recognize them, Delta, Generals, you know, household names, not some strange thing, not some small thing, who have actual bonds outstanding. All right? They have actual bonds outstanding, real bonds. So what I did is I took 3 data points. How can I compute the cost of the guarantee for each of those bonds? Well, I just showed you. Value of the bonds as if they were treasuries. You know how to do that. You look at the treasuries, you apply that to those bond promises. Subtract from it the actual market price of the bond, and that gives you the market price of the guarantee. So you see, again, not a particular theory in sense of modeling, it's just simply calculation. All right? So let me just show you the numbers. Whoops, sorry. Bad hand. I got to get the right one. All right, let me just show you. So I went to August of 2019, no COVID as far as we know, right? Here are the various premiums. You might be surprised, by the way. Apple, 5% of the value of the bond is the cost of the guarantee. It's not 2 basis points or something like that. It's 5%. This is in, quote, normal times or non-COVID times. And you could see the numbers here. They range from 4, so forth for Walmart, up to, I don't know, well, they roughly G or something, 15%, okay? So everybody see that? Now let's go forward 6 months or so, 7 months, to COVID in April, not at the bottom in March. By the way, the markets, I give you the stock market there because that's important. Why? Because the stock market is telling you something about the value of the assets that underlie that, which you've written the guarantee on. How much value is there, actually. So the stock market is not irrelevant to this issue of the credit. Now, look what happened to Apple. It went up 50%. So the same guarantee, same bond, is now 50% higher value to the guarantee. If you've written the guarantee, you would have your liability went up by 50%. 50, not 50%, 50% of the value. So it's a big number. Citigroup. Look at Delta. Of course, we all know what happened to the airlines at COVID. Delta the guarantee was 14. It's 74%. These are market prices in mainstream companies, not some little Bitcoin or something like that. These are mainstream of the economy. So that was a huge one. But General Motors more than doubled. Microsoft up 50%. Walmart up 70%. ExxonMobil doubled. Do you understand? Those are real prices, things that you look at. All right? What is that telling you? These guarantees value in real world, no matter what your model is, move a lot. The idea is that bonds, they move a little bit, they're going to be coming back, and et cetera, et cetera. This is what people are willing to buy and sell for, and not college professors, ribbon clerks, or taxi drivers, but professional investors, institutional investors, not just some, or meme stock types or whatever, okay? But now I want to show you. What happened when we go 6 months forward, a year later from when we started? Let's look at those bonds guarantees. By August of 2020, it's halved. It's gone back down. In fact, it's lower than it was here. Look at, now Delta is half of what it was here, but much higher it was there because Delta, the airlines are still having a big problem because of COVID. What action happened in that period? Miracle of miracle, we got a vaccine. If you've ever been around vaccines, if you think that's a normal recovery, it's not. Almost anyone you talk to in vaccine would say, you're lucky if you get it in 5 years. The fact that we got it was great, but the idea is that, you can depend on it coming back. I think you get my point. So by showing you the data, I wanted to get you to see 2 things. One, how much the cost of these so-called contingent claims change, which are not carried on the balance sheet. You worry about $37 trillion in debt. How about looking at that number? How about looking at that number exactly at the time when you're most vulnerable, in the middle of a crisis? And if you just pretend, oh, we looked at history and it'll come back, that's the wrong model. These are contingent liabilities. They're derivatives. They depend on the value of what's under it. If you want, let me just finish here. Russell was 1931, fell to 1550, actually 1260 here, and was back to higher than the previous August at that same level the year later. So you see, as the assets, the real assets, market price assets, not marked to, marked to model or marked to a book or something, but real values were here, they went way down here, and they came back. Had they not come back, those things would not have come back. This is not some bounce back of some fundamental rule. Survivors tell the story. I'm sorry to emphasize this. So when you survive, you say, it wasn't that bad, we're here. The ones who aren't here are the ones who understand what that risk really is. Okay, so last point. This gets really complicated, so I'm just going to walk off with this. And this is the following. When you have banks, we're going to look after banks. We guarantee them. The government guarantees the banks, right? Now, what happens, and we don't say in this country, of course, but let's say in some other countries, what happens when that country has trouble issuing its debt? It goes rolling over or trying to do debt, and nobody seems to want to buy very much of it. What is a very common practice? You go to your banks and you say, don't you want to buy our debt we're issuing, your guarantor? Guess what? They often do. I wonder why. I don't think you need me to answer that. So what have you done? What have we learned from our credit analysis? The banks are buying the government bond. If that government bond is not risk-free, they're writing what? A guarantee, right? Because remember, buying a loan is a risk-free minus writing a guarantee. So the banks are guaranteeing the government, and the government is guaranteeing the banks. Now, think about this as a dynamic. A shock hits either the government or the banks or both, okay? But let's say it hits the banks. Well, what does that do to the government's balance sheet in terms of value and risk? You saw, remember, it gets much more risky when the asset goes, the liability goes up, okay? It's much more, it's not 1 cent per dollar, it's 5 cents per dollar, 10 cents per dollar, okay? So two things happen. The value of your liability goes up, that makes you the value, but that's why you have to use a risk balance sheet. You have to look at the risk. You can have something that has very little footprint, and one way you get that is if you take assets of something, the asset of something minus its liability, you net. You can have a very small number for nets. A swap, when you buy it, has zero value. Does it have zero risk? Well, of course, we know the answer to that. It has the same risk, it's just extremely leveraged. Well, that happens every time on a balance sheet you simplify and you take the netting. Because you're not, unless they are the same risk, if I have stocks to guarantee pensions, you take the difference in assets and liabilities, if they're fully funded, it's zero. Is it zero risk? Absolutely not. It's the biggest hedge fund in the world in terms of risk. It's 100% leverage, okay? I don't think they'd call that risky. You're taking the stock market and levering. So what I wanted you to see is what happens when the guarantee guarantees the guarantor, et cetera. A shock hits the banks. The liability of the government to guarantee the banks goes up. That's bad because the assets of the government, the net value of the government's going down. Well, what else has happened? That same instrument called the guarantee is now 3-4 times more risky. So it's not only bigger liability, therefore lower, you're more leveraged, but you're missing the point just to look at the measured leverage by the numbers. The risk of the underlying that's being guaranteed has gone way up. That's what I want you to see. That's how you get 10 sigma events when reporters were calling Goldman Sachs and saying, you know, how likely is a 10 sigma event? And of course the person would say, 1 in a gazillion. And then you say, well, we had 3 of them. And they think that's fat tail. It is a fat tail in one way. It's the wrong number you're using. You're thinking the risk is the same from your 10-year regression or even from last year's regression when things have changed. And if I can, any other story to you this morning as to why we need to have, for decision-making and analysis, we need to use balance sheets that have that kind of information, not what's GASB or GAAP or allows you to change a regulation to bail someone out. All right, I'm not being pejorative, I'm just telling you about use. But it's even worse than that. It's feedback I described to you. Think of Euroland, okay? Greece, not picking on it, but Greece has a problem. That's a problem for the Greek government, right? The banks in Greece. So you're another one of the members and you say, well, I'm sorry for them, but too bad they didn't manage themselves well. Until you find out that your banks, not the Greek banks, but your banks have written guarantees, credit default swaps, on Greek debt. Guess what? If Greece goes down, those credit default swaps are going to have to be delivered on. The risk to not Greek banks, but that other country's banks has gone way up, exactly as if they were the ones that were in trouble, because they are, all right? Now, you suddenly see things a little differently, because if Greece goes, we're going to have a problem. So maybe we better review that. Okay, I'll quit on that. Sorry about running over, but I warned you.
Fantastic. Okay, wow. Pretty cool. Jason, you're up.
Thank you very much.
Wait, the clicker, do you want the click? Your
yes,
slides are coming up. And Bob, do you have the click? Can I hand over the clicker?
Yes,
Thank you. Okay.
All right, thanks very much. And usually I find government sector balance sheets conversations aren't that exciting, but that was enjoyable, and I hope I can keep up the pace. Now, I work at the IMF, so I take a broader perspective than a lot of you. I look across the world. And what we find is that government balance sheets are poorly understood, rarely managed effectively, and are the source of macro-critical issues, as Bob pointed out, usually when crises hit, and we've had our fair share of them. They're also really big. Our estimates are that they're about 200% of GDP on average, and vary considerably on both the asset and liability side. So they have a really big impact on how governments can respond to shocks, but they also offer a lot of opportunities to governments if they choose to manage them better. Now, at the fund, we've been paying a lot more attention on government balance sheets because we've learned the lessons of those 10 sigma events in a lot of our member states. And we're now at the point where we're collecting and publishing data as well as analysing them for most of the countries in the world. So you can go onto our data sheets, data sites, and take a look at them. And the more that we look into them, the more we're realising that they matter. And that's for a couple of reasons. So while they're fairly staid and stable during good times, small movements, during crises, they can drive the fiscal and macro outlook, and rarely for the better. Big parts of that come from mismatches within the balance sheet, so exchange rate and interest risks on the asset and liability side. But there are also a lot of troubling issues that escape notice unless someone goes delving into the far reaches of the balance sheet, or they thrust themselves onto the front page of the newspapers. Talk to anyone in South Africa who's had to deal with their power company, and you'll understand that. I learned that lesson personally. I was on the ground in Portugal negotiating the IMF's program in Lisbon in the financial crisis. And the established fact, general government debt, the kind of basic unit that the IMF functions on, kept moving on us. And I'm not talking about forecasts for that. I'm talking about the existing numbers. What happened was that SOEs, so public corporations, public-private partnerships, and the banks kept on being reclassified within the government boundary and adding to government debt. That's 20% of GDP increase, up to above 100% of GDP in the space of a couple of weeks while we were there negotiating. For us, it was like standing on shifting sands. We didn't know where we were. During that crisis, hidden debts were responsible for around a quarter of the unexpected increase in debt across the advanced economies. And we learned that when it rains, it pours. It's not one bank, it's two, it's three or four. It's not just the banks, it's the SOEs. It's not just the SOEs, it's the power companies and other important elements that the government isn't going to let fail, even if they don't have an explicit guarantee. Now, our experience is while governments do have a really good understanding of their core budget, every budget director knows where the money is going, they have little understanding or knowledge of what's going on in the broader balance sheet. Many governments can't quantify their balance sheet or even their financial assets, let alone understand them and their evolution or their exposures. We see this opaqueness across the board, also in things like physical capital stock, where uncertainty over valuation reigns, maintenance isn't provided for because they don't know what it's worth or what it needs. And this uncertainty creates a lot of risks, but also some big opportunities. Another point is that during crises, government's first policy response is to use their balance sheet to support the economy. This is true in the financial crisis, where you had the support for financial sectors. And talking about the convexity of convexity, I think the price of that support was much greater during the crisis than it would have been considered a few weeks beforehand. We saw that in Iceland and Ireland, where that support overwhelmed the government's balance sheet, and they had to come to the IMF to be able to roll over their debts. Their banks were certainly not in a position to do so. It was also true in COVID, where the first response of almost every government was to step in and provide support to a private sector that they were shutting down for health reasons. And that support was about 6% on average in most countries, on average, but up to 30% of GDP in some, so really big. And these provision of support can have long-lasting impacts on government balance sheets. You see the scars from the financial crisis today if you look at them. So it's really important that they understand their balance sheet, understand what capacity they have to use in there, how much spare room there is, but also what those interventions will look like. And the understanding of the risk pricing of that is a really important part. Yep, here's the first one.
Perfect.
So here's a snapshot of what government balance sheets actually look like across the world. Now, this is from 2021. One thing that's tough about this is really hard to collect the data. It comes with a big lag, and it's a huge effort. But you can see they're pretty big, 200% of GDP on average. Let's start with the liabilities. The main focus of fiscal policy is debt and deficits, and that's general government debt that we tend to look at. This is a lot larger than it used to be, but it only makes up half of the public sector liabilities out there. So if that's all you're paying attention to, you're missing a big part of the game. Civil service pensions, state and enterprise debts, and things like payables, unpaid bills, which make up a larger share of IMF program issues than you'd imagine, are some of those remaining. All of those are debt-like. They entail a stream of payments into the future in the same way that debt does. They're contractuals. The asset side is even larger, looking at 135 trillion US or 240% of GDP. Financial assets are the biggest chunk of that. Cash at the bank, sovereign wealth funds, pension funds, and loans that the state grants. Public capital stock is another major part. That's the infrastructure, bridges, hospitals, etc. And then you've got natural resource assets, the subsoil assets that are under the ground. They're not something to be ignored in cases like Norway or Saudi Arabia or Qatar, for instance. How does it look across the world? Well, here's the set of countries that we have for the full public sector. There's a lot there. You might have to squint to see your country. What you can see is the assets are in blue, liabilities are in red, net worth is in black, and the yellow is the general government debt figure for the country. Countries on the right-hand side, they're the ones with positive net worth. They're doing well. Who are they? Countries with very large natural resource endowments. Norway, Kazakhstan, Australia, Russia. Any consideration of public finances really needs to pay attention to those natural resource assets, because that's not just an income flow, but it's an asset that varies as prices change. Countries on the left-hand side, well, not uniformly, but they're the ones who suffered the most in the financial crisis, and they can continue to have those scars on their balance sheet. Where does the US sit? It's about 2/3 of the way on the left-hand side. You'll see it's got negative net worth, not a surprise to those who've looked at the Treasury numbers. Used to be positive before the crisis, positive 20, now it's dropped down quite considerably. So why does it matter? Why do we care about this? Well, at the fund, we didn't just collect the data, we wanted to answer this question. And one thing that we know is that having negative net worth on a static balance sheet, or what the accountants say, is you're not insolvent like a private company. You've got a really big asset sitting there, which is your ability to tax in the future. So how do we account for that? More on that later, and I think we've been touched on that with some of the work that Bob's done. We took an empirical look to work why these balance sheets matter for macro purposes. 3 big findings. The first is that stronger balance sheets means greater resilience to shocks. Countries with stronger balance sheets, in this work it was defined as net financial worth to get around the illiquidity of your capital stock. They have shorter and shallower recessions when hit by shocks. The intuition behind this is that those countries with stronger balance sheets can use them and respond more forcefully with increased government expenditure and using balance sheet measures to support their economies. The second is that there is real potential for revenue gains. And those of you who have dealt in budgets know that finding 0.5% of GDP to fund a new program is incredibly difficult. Well, we find that one of the flip sides of the lack of visibility on government assets is that often comes with benign neglect. Countries aren't managing their assets very well. State-owned enterprises have a 0% return on average. That's a pretty poor return for a very large investment and very large risk associated with that. So improved asset management, when going through that, could yield an additional 3% of GDP in revenues. And we're not talking about all 240% of GDP of assets here. We know some of those are not revenue-yielding assets. You're not expecting revenue from your hospitals or from your roads or those kind of things. But we're talking about commercial or financial assets where the government should be earning some return on that. A really nice example of this is New Zealand, who spent the last 10 years really sharpening their approach to their asset management. Look at their investment strategy as a good guide to how to do so. Now, the last is that even if the numbers on balance sheets are uncertain, and we know there are valuation issues abounding, it's hard to do, but we find that countries with stronger balance sheets pay lower yields on their debt. So it's recognised by the market, and if you're paying attention to what Bob's talking about, you get a good sense of why that might be. Intuitively, this makes sense. Norway, with a huge sovereign wealth fund, is going to pay less interest on its debt than a country that with the same level of general government debt would, because it's got a large asset that it can use. We find that a 10 percentage point improvement in net financial worth translates to a 10 basis point reduction in yields, holding everything else constant. Now, I'm an economist, not an accountant, so putting together all of this information is interesting, but only to a point. They tell the story of what's happened. The balance sheet shows the state of the cumulative impact of all your past decisions, but they don't really tell you much about the future. So we took these static balance sheets and supplemented them with 2 things. That greatest asset of the state, its ability to tax, but also its biggest liability, the cost of future policy promises, to come up with something that we call the intertemporal balance sheet. And I'm really glad to see we've seen a few examples of this analysis over the last couple of days. Now, this can get really interesting because it provides a platform to combine policy analysis, long-term solvency, and fiscal risk assessment. So some quick examples of this work. One shortfall of balance sheets, if you look at them in the static sense, is you include the pension assets in your pension funds, but you don't include the biggest liability, which is your promised flow of payments from those. That's incorporated in your projections. So you bring them together, and all of a sudden you can do some really interesting work on demographic change, health costs, climate change, and pension costs. We've done this work in Norway and Finland, compared a country with a really big asset base in its static balance sheet to a country in Finland, who's reformed their pension sector, and you find some really interesting results in terms of the intertemporal balance sheet there. A second thing that we can do is fiscal stress tests. So you take into account the range of balance sheet impacts from broader macro and fiscal costs of recessions. And included in that is you're looking at the potential implicit costs or explicit costs made true of the financial sector, which is really interesting. Our team did one of these for the US. This was pre-COVID, and there was some really interesting identifying the exposures weren't on the federal government side, but on the state who have the big pension funds. And those variation in their equity holdings have a big impact on things during crises. Finally, one of my colleagues, Yugo Koshima, did a really expansive piece of work where he put together those intertemporal balance sheets for the G7 countries. And for those worried about intertemporal budget constraints, and I think there are a few of them in the room, the results were quite striking. You can see that, again, this was done pre-COVID, so the situation deteriorated further. But you can see of all the G7 countries, no one's even approaching their matching their intertemporal budget constraint in the long run based on current policy. And I think the point here is if something can't continue forever, something has to change. In there, he gave some guides on how big those changes may need to be. He also found that, again, the markets seem to pay attention to this, and if you're looking at the slope of your forward rates, your forward yields, you can, these explain a decent-sized chunk of those differences across countries. So the more that we at the fund look into government balance sheets, the more we realise they matter. Taking the usual perspective of focusing on government deficits and debt is still important, and the fund's lending still depends on assessments of debt sustainability. But focusing on them means missing the broader picture and ignoring activities that can and often do eventually rebound onto the government debt, often at the very worst time. So for that reason, no assessment of fiscal sustainability or fiscal risk should be done without understanding the full scope of the balance sheet. But it also provides some really good opportunities to raise increased resources and better utilisation of public assets. And finally, it's a question of transparency. The government has a very large asset that it holds on behalf of the people. How is it using it, and how is it helping the public and provision of public goods to those? And that's a really important part of it too. Thank you.
Thank you very much. That was fantastic. Okay, and so we have Bob Litterman from the Denver airport up at the crack of dawn to do this. We thought it was important to drill down into something that's definitely missing from most balance sheets, which is environmental assets and liabilities. And we asked Bob, who's a great expert on all of this and on finance and on the environment, to talk to us about that. Thank you, Bob, for
Well, thank you. It's a pleasure to be here, and I apologize if there's background music and it's distracting. But bottom line is, if you want to think about environmental assets on balance sheets, you have to focus on it as a risk management problem. And the approach of taking risk seriously can have a dramatic impact on the results that you get. If we think about climate change, the most well-known model shows that the optimal policy is a slow policy ramp. The price of carbon should be low now, and it should increase slowly into the future. But when you take the environmental assets seriously, and I'm going to think of carbon in the atmosphere as a liability, you can think of nature as being an asset, but I'm going to focus on carbon for the moment. And when you think about it seriously, you can get a very different result. Kent Daniel, Gernot Wagner, and I wrote a paper called Declining CO2 Price Paths. So we got a completely different answer for what the optimal policy should be. And so I'm going to illustrate that with a couple of slides. Let me see if I can share my screen here. Share. Okay, are you seeing that now?
Yes.
Okay, good. So we build a tree structure, as you can see. Time is moving from the left to the right, and We have different periods in this, and then we have nodes that represent what we call the fragility of the environment. And so each of those nodes represents a response in terms of damages to a given level of radiative forcing. And the amount of radiative forcing at a point in time is going to be a function of the amount of emissions reductions that you've done previously. And so at each of these nodes, there's both an amount of damage that's a function of the fragility in that node, but also a function of the amount of CO2 in the atmosphere at that point in time. And policy is going to be to set the price of carbon. And what happens over time is that uncertainty is resolved. If you move from the first period in 2015 to the second period in 2030, moving up means that you've eliminated the possibility of getting to the least damaged state. So it's a bad move. If you move down, you've eliminated the most damaging state. And so that's good news. And then if you move in the second period to the same node, well, you're clearly here with the same amount of damage per amount of forcing, but you have a different amount of forcing. So there's really a number of states, and now what you're going to do is optimize policy at every one of those nodes for every one of those states, assuming that policy is optimal in all of the states. Now, there's a lot going on in this model that I'm not going to get into, but as we move through the tree, what we're going to see is different policies. And so if I go to the next slide, let me see here. Oh, I didn't do the slideshow. So let me do that now. And so now you can see, I don't know if you can see that first slide very clearly, but hopefully you can see this second slide. And what we're showing at each of those nodes is the price of carbon that's optimal in that node. In the first case, we see about $120. Now, I should say that there's a lot of parameters going on here that we play with, but what we're showing is what we call the base case, which is where we've tried to push everything as far toward a lower price as we thought was reasonable. My colleague Gernot has redone this analysis with what he thinks are more realistic parameters, and he gets a much higher price, about double what we show here. But it's really the pattern that I want to focus on and what's going on. So if you get bad news and you've eliminated the good state of nature, you get a much higher price. It's gone from about 120 to 175. And if you get a good news, well, then you have a lower price because you've eliminated the most damaging case, the worst case. And so you have a lower price and you have more emissions into the atmosphere. And then you get to the next period and you can see that you get different prices, even given the same sensitivity. But if you get more bad news, then you get a higher price. Now, we also have technological change going on, and so it becomes cheaper over time to remove emissions and to pull them out of the atmosphere. But what happens is you get a dynamic where basically the expected price is high at the start because you have to prepare for all of those potentially bad states of nature, and then over time the price goes down, both because technological change, but also because you've followed an optimal policy. And it's an optimal policy assuming optimal policies at every point in time. And so instead of a slow policy ramp, you get a slam on the brakes scenario where you prepare for the worst case, but you expect that you're going to solve the problem. In fact, we built tipping points into this, allowing for catastrophic outcomes, and you never get them with an optimal policy because it makes a lot of sense to be prepared. And the other thing I'll say is that obviously what we're doing here is we're maximizing utility, expected utility, given the expected utility at every future point. And so bad news is much worse if you're in a bad state of nature, that the damage is much worse because marginal utility is much higher. And so what happens in this world is that you don't get any of those bad outcomes because you're preparing for them. The other thing that's really important, and I want to emphasize, is that if you think of the optimal policy as a slow increase in price, you don't worry too much about time and urgency, because if you get bad news, I guess in that world, you just have a slightly higher price. Well, there's no news actually, because there's no revelation of new information. But in this world, you do react to that news, and so it has a dramatic impact on how you behave. So with that, I think I'll stop sharing the slide, and I think the point is kind of obvious. And now the other thing that I want to talk about, you can think of nature as being a positive asset, but these two obviously do interact in the sense that higher damages from climate are going to be impacting the positive services that you get from nature. And so it's, I don't think the fact that we're focusing only on climate is particularly important. Now, the other thing I wanted to mention while I have the floor is that there's a new initiative. We're calling it the Climate-Related Financial and Macroeconomic Risk Initiative. It's being started by the Salata Institute at Harvard, Jim Stock, and Resources for the Future, Billy Pizer, and has a number of other academic institutions that are starting it, including MIT's Gallup Center, and I think it's the Climate Institute or something at MIT. And we also have NYU, I think, Stanford, and I'm not sure, maybe Chicago, all participating. And this is really a follow-on to something called the CFRAC, the Climate-Related Financial Risk Advisory Council, which was part of the Treasury Department under the previous administration. A couple of weeks ago, it was shut down by the current administration, and so we're moving it into academia. We're increasing, it's a group of both academics and practitioners. We were advising the financial regulators, but now we're going to broaden the mandate a little bit, both in terms of who we're advising, the research that's being done, and also focus on, I would call it, fiscal sustainability as well as financial stability. And so with that, I think I'll pause and we can have a discussion.
Great, fantastic, thank you. Well, I neglected to say at the start, but I'm so thrilled on this panel to have people who are just at the core of making these issues recognized. Bob, of course, with his work on credit as an option, and the power of those ideas have just been spectacular, and kind of this application is amazing. But also at the IMF, I don't think it's often appreciated the work that your group has done on balance sheets, because it's one thing to say that government should do it, it's another thing to convince them to actually find the data and report it. And I think, you know, the progress is amazing. And then Bob Litterman's work on the environment, you know, taking someone with a really an investment management perspective, but bringing it to nature and climate and everything. So I think we're very lucky to have all three of you. But stopping with the compliments and getting to stuff, I have a question. So all my questions are questions that all three of you could weigh in on. And this first one is a bit nerding out, but I couldn't help it. It came from, in a way, from Bob's example, where he explained that a credit guarantee is a risk-free loan and a risky loan. It's kind of the difference in the value of the two. So that's one way to represent the assets, the value of a put option. Or you could just say, well, the value of the put option is whatever the value of the put option it is. But the value of the assets and the liabilities are going to be many orders of magnitude bigger than the put option. Why does this matter for balance sheets? Well, if you take Fannie Mae and Freddie Mac and the accounting profession, you know, the question is, if you have a contingent liability, how do you bring it above the line, so to speak? Because now most of these contingent liabilities are below the line, which basically means they don't appear on a balance sheet. You know, there's a footnote which says we have this contingent liability, but you haven't brought it onto the balance sheet. Now, the way Fannie Mae and Freddie Mac are brought onto their own balance sheets is what Bob said, which is they bring on the asset and they bring on the liability. So if you look at the balance sheets of Fannie Mae and Freddie Mac, those balance sheets actually look like they're, in sum, about $6 trillion. If instead on their balance sheet, they simply recognized the value of the credit put option, it would be much, much smaller because, you know, mortgages only lose about 2%. Even in a bad state of the world, they don't lose that much. So the companies, if you accounted for them based on the put option as a liability rather than the whole assets and the whole liabilities, would look much smaller. And so my question, I've never asked you this, Bob, do you have a preference in the accounting world for how to do that? Because I think it does change the way very much things are represented. And it's also a question for if governments were to put these on balance sheets. You know, do you have views on, which I know none of you are accountants, you're economists, but it seems first order for understanding the situation.
Well, you were asking me.
I'm asking you, yes.
There's a couple of Bobs here. Anytime you net, you know, right tool for the job is the first statement. What question are you trying to answer? I first showed you the whole debt, but the thing that was driving all the credit risk was the guarantee. If you didn't have the guarantee, you'd have no risk, or at least minimal, all right? So that's when I switched to see how much the insurance, think of the insurance you buy for any sorts of things. Imagine if your premiums for insurance went up by Delta went up, what, 6, 7 times? I mean, you know, so the first answer is there's no one thing to look at. What you look at is the thing you need to look at for the job or the decision you're trying to make, and that's number one. I mean, but often that's forgotten. That said, let me just give you a very simple-minded choice. Suppose we have 2 pension funds and you're sort of responsible for their risk if they blow up, you're the PBGC or something. And I tell you, one of them has funding that is 5% or even 10% above the liabilities. Looks very strong. And I have another one that's just right at 1.0. It has no extra. Which one is safe? Which one do you worry about more? You can't answer that. The one that's 1.0, what if it's holding treasuries, match funded, tips, whatever, to the liabilities? Yes, it has very little reserve, if you like, but it doesn't need it because it's very safe. Why do we allow banks to have as much leverage as they do? It's because typically their liabilities and their assets are very close. So the net volatility is very small, all right, when things are normal. So my first point is that you, in my view, you have to look at both the valuations, but you also have to look at the risk. And I thought the most dramatic way for you to see it, using the real world on a scale, you know, of the biggest firms in the United States, that how much that number can change. And if you're just going with numbers to say, well, it's not that big, and I think the swap example is the best one. Our futures contract, when you get into it, has 0 value, so it can't have much risk, right? Wrong, because it's highly levered. You can't just these days, or maybe any days, use simplifications of that sort when you're thinking about, especially when you're thinking about risk. Pay attention to the risks. That's what hedge funds do. They don't look at how much leverage they have in numbers by value. They look at how volatile is that whole portfolio. And that's how they think about it, because they're extreme. They are the people that do the most sophisticated risk management. And I suggest that we don't have to be like a hedge fund, because that's not its purpose, but that we should use that mindset that what matters is the risk to the system as well as how much cushion you have. And without that, I don't see any way you can really make an intelligent decision or informed decision.
And I don't know if either of the other two want to comment on that or not.
I agree. I think the approach that we've taken is it's really unsatisfying to have notes in a financial statement that says you've got these guarantees. that doesn't really give you any information. We've started taking an expansive view of what the government is looking at control. So we have the public sector incorporates things like Fannie Mae, Freddie Mac, incorporates the central bank and looks at the risk exposures of those. We are looking at the assets and liabilities of those entities and rolling them in. And then we can do some risk adjustment given the volatility of those different asset classes that are in there. And we've come up with some risk-adjusted asset liability positions, which goes some way, certainly not all the way, to get into it. It doesn't pick up that implicit guarantee to the banks, the financial sector. That's outside the government's guarantee, outside its control for the most part until it isn't. But that's kind of where we've got to, but we're not all the way yet.
Right. And so the related question for Bob Litterman is some countries have actually started to put natural resources on their balance sheets. For those of you who aren't familiar with the US chooses not to. They have this idea of what they call heritage assets or stewardship assets. So if you look at the financial statements of the United States, they say we recognize these assets exist, but we're not going to put any value on them because they're intended to be preserved for the public forever. So they're not available to be used, and so we don't, account for them, which one may think is unsatisfactory, but Bob Litterman, you must have thought about these issues and whether, it's better to try to put them on the balance sheet despite how difficult it is. The work you just described is kind of a step, but is it better to try or to just leave them as zeros?
Well, I would say, first of all, you have to think about what matters in a particular context. So if we take a petrostate, where 99% of the wealth of the country is oil that's underground, then recognizing climate risk is going to depreciate the value of those assets dramatically. If you think about a low-lying island that's going to be underwater, climate risk is going to wipe out the assets of the country. And if you think about, I'll call it a nature state, which is undeveloped nature, you're going to have depreciation of that asset, but you may find that nature over time becomes much more valuable in general. So what you have left, the value goes up. If we think about the United States, we've got so many different things going on. I think it's pretty complicated and hard to guess what the net result would be. But it's clear you have to think about it and take those into account if you want to think about the impact of environmental assets on the balance sheet. In terms of measuring, I've focused on carbon because it's kind of the simplest to measure. It's still very complicated, but it's a heck of a lot simpler to measure the amount of carbon in the atmosphere than it is the value of biodiversity, for example, or the other services provided by nature. So it's a very complicated problem for sure. And one final thing I would say is that, looking at the change in value, let's say, of nature over the next 5 years tells you virtually nothing about what you should be doing in terms of risk management, which requires you to look, hundreds of years into the future.
Right. I have more questions, but I'm going to open it up to the audience. And if anyone has questions, please come up to one of the microphones. Doug Elmendorf, you can lead off.
Thank you all for really interesting comments. And I'm going to go home and study up on the U.S. government's balance sheet more carefully now. But my question is how you think about the risk of government intentions, declared intentions that aren't quite legal commitments. So if I take your balance sheet, if I understand you correctly, the liabilities are things that are legal obligations of governments, actual promises to pay pensions that we presume would be enforced by law. But of course, governments make lots of promises of a vaguer sort. And I'm curious how you would think about the risk of those sorts of promises and possibilities as you're trying to tote up the overall risk that governments face going forward. Thank you.
Well, it's a very good question, and I'll give you the way I think about these. I try to have everything be the same mode of thought. I don't keep changing for each of these. So your question's quite right. that there are many things that you're not legally bound to do, but, you know, they're not legally bound to bail out FDIC or the old FISLIC. But everybody believed that you were going to do it. That's why people kept putting money in banks, even when those banks, evaluated by themselves, would be quite risky propositions. And then, of course, you know the feedback. The feedback is everybody says, we know that the government, the Congress or something, is not going to let the deposit insurance fail. And so now you've guaranteed the deposits, even though you don't measure it as that. So one of the things you have to do is, of course, recognize what kind of obligations you actually have. And you can get estimates of that from market data. I don't want to get off into the weeds, but everything I talked to you about this morning is doable. Is it doable perfectly? Of course not. But there's data that you can use, I mean, hard market data, where things are changing every day, not sort of averages over 30 years or something, or every time you have a balance sheet come in, that you can use to estimate those. How better? It is more important, in my view, to recognize they're there on the balance sheets, that the contingent claims are there, and get a sense of how much they've changed. Whether the numbers are exact or not is not that important, because you're not going to know those. But you're going to know what to be thinking about. And if you see those numbers, like I showed you, in your models blowing up, and you look at those slopes that I showed you, have gotten a lot steeper, I hope that that's a bell to you that things aren't the same as in the past, and you can't just use the historical numbers. So that would be my main message, is it's identification of risks, recognizing changes in the risk, but I don't see how you can possibly make a decision whether something's safe or okay or within the range, as you know, the doctors tell us what our medical evaluations. How do you know whether you're in the safe range or not if your risk is changing? And I guess the message again, I know I'm repeating it because I'm saying it's the same answer. You've got to understand how the risk has actually changed as best you can. And what I wanted you to try to see, in my contribution, is that I'm holding the same thing, but it's not the same thing from a risk point of view. And you better be aware of it.
Version of the answer for what the IMF is trying to do with not booked liabilities?
Yeah, so I mean, I'd take the example of pension liabilities. What's on the balance sheet are civil service pension liabilities in general, because there is a contractual obligation. But for the general community, it isn't. It's not there. But it is a policy for the government to provide that. So we bring that in that intertemporal balance sheet. I think it used to be at the CBO, we use the CBO projections to say, no policy change, this is a cost of future policy, and we bring it on. And that way you're kind of getting, you're not being bound by the accountant's contractual requirements. You're actually picking up both sides, both the asset and liability side of both of those explicit and implicit obligations.
I was wondering about some geopolitical issues, and this may be tangential and you can ignore it. But looking on the balance sheet, like sovereign wealth funds in the GCC, they use some of those monies for political influence, Harvard and MIT, buying the current administration. And I don't know if that's an asset or a liability, but I think it's maybe an important thing to consider somehow in thinking about all of these issues. And then similarly, how should an investor think of this, like knowing that Japan does not do any of this analysis you've done, and they have quite a lot of money. I've never heard anyone say, we have to look at Mongolia as an investment, even though your numbers are pretty compelling. Similarly, I don't think that it's too provincial to say, I'd rather invest in America rather than Russia. I think anyone would say that. Maybe I'm just, again, too thinking of America. So we have investors here. We have a large investor represented. We have the people doing the analysis. So I mean, to me, this is important. I don't know if it's relevant to what you're doing. Thank you.
Does anyone have an answer? Bob?
Well, if you want the airfield for a little bit. Yes, no?
If you want to address it, Bob Litterman, you were nodding your head. I don't know if you had anything
Bob,
to say about it.
I don't know. If you got Bob, Bob should.
Bob was nodding his head, so I wanted to see if he had anything to say about it.
Well, I guess when I think about it from an environmental perspective, it's all about government intentions, and it's a problem of coordination of governments that have different interests, and so that it's a political problem. Is ultimately climate change is really much more political problem than it is an economic problem. We know we should be putting a price on the risk, and we can argue about what that price should be, but I think everyone would agree that we should immediately have an appropriate price on carbon, but getting there is a real problem because of the free rider problem from different governments that have different perspectives, and ultimately what we need to do is increase dramatically the amount of investment in low carbon assets, and that's all a question of, do you expect carbon to be priced in the future? And I would have to tell you that most serious investors don't expect it to be priced, and therefore we're investing, a small fraction of what we should be. And so how can we increase expectations that governments are going to, work together? That's pretty hard to do, and I don't have an answer. Well, actually, I do have an answer, but it's not a good answer. I would say the best prospect right now is bilateral negotiations on tariffs. You've got the Europeans who have already said we're going to put a tariff on carbon. You've got a US president who says, I love tariffs. And if you get a couple of countries like Europe, the US, maybe China, to agree we're going to put a price on carbon on imports, you could pretty soon get some sort of coalition that everyone would want to join. Now, another problem that we have is that we don't actually measure the carbon embedded in products, in imports. We have a crazy, what they call GHG protocol, which is an approach that's not accounting. It double, triple, quadruple counts carbon, and it's a disclosure regime. It's not an accounting regime. So we have to do serious carbon accounting, measure and monitor its flow through the economy, and put a price on it. And as I say, I'm not optimistic, but you never know what might happen.
Yeah, please come on up, and then you'll.
Hi, Con Hurley, Boston University. I would just observe that the Federal Deposit Insurance Act does state explicitly that deposits are guaranteed by the full faith and credit of the United States. That is as contrasted with Fannie and Freddie that we talked about yesterday, and with the federal home loan banks, where the guarantee is merely implicit. Now, of course, in the case of Fannie and Freddie, it became explicit during the financial crisis, but perhaps the answer is to recognize that explicit guarantee of deposits by the taxpayers in the pricing of deposit products, and also to recognize from an accounting standpoint the value of banks borrowing from home loan banks. That's 1.4 trillion outstanding, borrowing from home loan banks at a discount, and that discount is on the backs of the taxpayers.
Okay. A statement accepted. Yeah. I don't know if anyone has any response.
Deposit insurance and
right.
Availability of funds explicitly rather than just...
Right. I mean, in terms of the balance sheet, the relevance is that we don't put a liability on our balance sheet. There's a contingent liability for the banking system that we don't put on the balance sheet, and certainly if one were to bring those liabilities above the line, there would be some recognition of those liabilities.
Look, it's the same thing. Look, when you were showing when Bob was showing the tree, you noticed that the tree had the feature of a whole bunch of flexibility options, that if you do this and you end up here, a whole bunch of things you don't have to do. If it doesn't go here, you have a whole bunch of things. The world is very explicitly dynamic, not just saying the world changes. And what we're saying, I think, in messages, where can we improve the balance sheets for information, for decision making? not something that unifies things, across. Accounting is not getting the best value, the best estimate of value, or even the best estimate of anything else. It's for comparability. So if you're doing an accounting, you have a different objective than you do when you're a decision maker, when you are the person that has to make the decisions, like you do at the IMF. And that's why I'm saying that if you look at that tree, it's much less risky than if you applied a simple model that says, no matter what happens, we're taking this to the end, and anything can happen by the end, all right? You will find, like on drug discovery, you wouldn't do a lot of drug things if you didn't take account of the fact that if a drug is toxic, you stop the policy. You don't keep going for another 10 years. So you have to look at the right tool for the job. So my answer to you is, if it's important for what we're worried about or thinking about, first you have to figure out if it is important. And you can't do that unless you analyze it. That's why I kept mentioning the swap. You can't just look at the value and say, it's not very big in value, so therefore it's not important. And that goes to the same thing with you, Debbie. You could have a huge balance sheet. Look, there's hedge funds out there with zillions of dollars and huge leverage, but it's got almost no risk of the fundamental asset versus liability. So that's my only answer to you, is the right tool for the job. You bring it up, you make your case as to why you're worried about it, do the assessment, evaluation, and then put it on the balance sheet if it's needed. You don't have to follow a fixed rule because the way you do for accounting. That's my point.
So we only have a few minutes. I think Laura's monitoring online questions, so I'm going to let her.
Actually, I don't.
Or her own question. It might be her own question. I don't know.
It's my own question.
Good. Let's hear your own question.
So we've really been talking a lot about liabilities, but we haven't really talked about how the government's ability to tax is represented on these balance sheets. And I'd like to know Jason and Bob's view, and maybe both Bob's views, about how to think about the nonlinearity of the revenue stream. So typically you make some multiplier assumption on different parts of the taxable incomes of various entities, and usually those multipliers are historic and they don't change over time, and of course the levels of income that you're taxing are also changing over time. As Bob pointed out, you need to think about where you are exactly at the time that you're looking at these sorts of things. So I'm wondering if the IMF is thinking more about, in this intertemporal balance sheet approach, about the revenues and what the ability of governments to raise revenue rather than just evaluate the liabilities.
Yeah, we do a fair bit of thinking. And both on the revenue and expenditure side, we have followed the approach of countries doing their long-run projections, and we usually just take those. In most countries, the revenue as a share of GDP is just held constant over time because that's it's a fairly stable. We do allow the expenditure side to shift as we see things like the demographic and health cost changes over time. So that's where we allow the movements. On the revenue side, in most cases, it's just a share of GDP. The UK team, when they were doing this is the Office of Budget Responsibility in the UK, they did try account for some of the revenue heads, and they just found the complexity in doing so added very little for no change in the aggregate. So they reverted back to just using the share of. I guess it can get incredibly complex as you try and push those things out. And we're going for tractability here as a general rule. But it'd be interesting to hear if the CBO, who do these on a regular basis, if they do more detailed revenue head and look at what one area where that can change is where you've got your income tax brackets being held constant, because policy is for those to be, the marginal rates at these levels of income. Over time, the inflation pushes that out, and if you hold those tax brackets constant, then you'll get nonsensical allocations because policy won't follow that. That's probably one thing that you do look through.
Thank you very much. Well, I think we're out of time, but let's thank the entire panel for a very good conversation.